Welcome to another edition of the Entrepreneur Maestro Series, your source of insights and inspiration from successful entrepreneurs and advisors. Here you'll find cutting-edge ideas and age-old wisdom that will help you grow your business more quickly. This series was founded and is brought to you by veteran entrepreneur, speaker, and advisor, Paul Morin.
This is Paul Morin. I'm here with Robbie Klinger today, who is an expert in business valuation, valuing companies of various sizes and stages of development. And we're going to run through a few questions that are of interest to the early stage entrepreneur and some that would be more of interest to those with a developed business. So Robbie, thanks for being here today.
Well, thanks for having me, Paul.
And I just want to start out with something pretty general, which, because a lot of people aren't necessarily particularly familiar with the topic of valuation. Can you just give a basic idea of, what is corporate valuation and what is it that you do to arrive at the value of a company, the basics of it?
Basically, valuing a business is just what the term implies, putting a value on the equity of the business or determining the worth of the business equity, the money that's been invested in the company, and how that value has changed over time. The value of any asset, whether it's a financial asset, an investment in private business, publicly traded securities, art, etc., is the present value, the sum of the present value of the cash flows that one might expect to receive from that investment. In this case of a privately held business, what cash flows could the owner of that business expect over a specific time horizon, 5 years, 10 years, 20 years, whatever their holding period is. We look at a variety of factors to come up with a risk-adjusted rate of return, discount those present values back into today's dollars, total them up, and come up with the value of the business. Now, there are a couple different levels of value, and oftentimes business owners don't distinguish between an enterprise value, or the value of invested capital, all of the equity and debt that have been invested in the company, or the equity value itself, just the amount of equity, the owner's dollars that they've put into valuing the business. I like to explain to business owners that when you think of enterprise value, think of the left-hand side of the balance sheet, the asset side of the balance sheet. The enterprise value, the invested capital value, is the value of the entire left-hand side of the balance sheet, all the assets, irrespective of whether it's funded with debt or equity. When you look at the left-hand side of the balance sheet, the total assets, you'll have your current assets, your cash, accounts receivable, inventory, etc., any fixed assets, plants, equipment, furniture, etc., and then you'll have the intangible value, the goodwill that may have been created from running the business, starting it up, profitably running it over the time horizon. That whole value on the left-hand side, the enterprise value, reflects both the debt and equity that have been invested in the company to arrive at the enterprise value. To arrive at the equity value, you would basically subtract the debt to arrive at the owner's equity, what amount of equity the owners have actually invested in the business, either through initial startup capital, retained earnings, etc.
Okay.
So there's a couple of different ways to look at the value of the business, and distinguish between enterprise value versus equity value.
Okay, that's I think that's very helpful. And on that topic of the different ways to arrive at the value, can you give folks a sense of what are some of the methods that you use to value the company?
There are three basic approaches to valuing a privately held business. You have an asset approach, you have an income approach, and you have a market approach. Within each of those approaches, there are various methodologies that can be used to arrive at an indication of value. For example, the asset approach pretty much just looks at the assets. Perhaps you have a book value method where you look at the book value of all of the assets in place at the time of the valuation to see if that's a reliable indicator of value. There's also a cost method, which would examine all of the costs and investments that would be required to recreate the business. And in doing so, you'd be arriving at a theoretical indication of value. You have the income approach, that looks at the cash flows available to the owners of the business over a certain time horizon, discount those back into today's dollars at a risk-adjusted rate of return. The third approach is a market approach, and within that you have the guideline publicly traded company method or the direct market data method. Public company method looks at other publicly traded companies that may be comparable to the company that's being valued and trying to extrapolate a value based on the public company multiples and applying those to the private company. Or the direct market data method, which looks at databases of transactions in other privately held companies in the business's industry and using multiples in those transactions to extrapolate a value for the business that's being valued. The appraiser will usually use several methods, maybe a direct market data method and the income approach, whether it be a single period cap method or a discounted cash flow method, and then reconcile those two values to come up with a final indication of value for the business.
Okay, so I understand that you're, in the typical valuation, you're using a couple or a few different methods to try to arrive at a value, and perhaps you take some blend of those depending on the particular business. In the case of the early stage entrepreneurs, can you provide any nuances or what aspect of these valuation approaches really is the most relevant? Because oftentimes you're not looking at an entity that has a lot of assets, and you may also have a hard time finding a market comparison. Does that leave you with the third method of discounting cash flows back, or what's your perspective on that?
You see this quite a bit with startup companies, entrepreneurs that have been running a business for a short period of time that don't have a lot of history behind them, or that are unique in that there aren't comparables transactions out there. In that case, we typically rely on the discounted cash flow method, which looks at the projected cash flow to the business owner and discount it back to a current value. And usually it's forecast-based. You'll have the business owner, the entrepreneur that's starting their business or may have started it a short time ago, with a business plan that may include a set of projections, of financial statements, balance sheets, cash flow statements, which we then use in that discounted cash flow method to arrive at an indication of value. It's very difficult sometimes to find comparable transactions of some of these businesses. In the event that there are transactions, we can use the relevant data and try to extrapolate a multiple that may be appropriate, and then perhaps weight it less than we would the cash flow method. The most reliable method is probably the cash flow method because it is actually representative of the future benefits that are accruing to the owner of the business, as opposed to a multiple based on a similar business that may not have the exact characteristics of the business that you're valuing, particularly if it's a unique niche business.
Right. One of the things I want to ask you, Robbie, is that you keep mentioning the whole idea of a discount rate and discounting cash flows back. We don't want to get too technical here, but I think that's a term that's used so much in valuation, it might be worth spending just a couple minutes talking about how you arrive at a discount rate that you use for discounting cash flows and how that would vary based on the riskiness and the age of the company.
Sure. There are a couple of different methods by which appraisers can arrive at an appropriate discount rate. The most common, and the one that I use most often, is a build-up method, whereby we start with a risk-free rate, which is based on Treasury bonds, 20-year or 30-year Treasury bonds, the yield on that. Currently today, it's about 3.5% to 4%, let's say. To that, we would add a company size premium and an equity risk premium. Now, those two premia are derived from a source, Ibbotson Associates, which has historical information going back to the 1920s to present day, and they do the analysis to arrive at the difference in returns on different deciles, size-wise of companies, and classes of equity over the risk-free rate over a certain time horizon. And the appraiser can go through their book that they publish every year, and it's quite extensive in how they arrive at the conclusion, and add and select which premium they want to use, add that to the risk-free rate. Then the appraiser has to decide, well, this is a general discount rate. This, at this point, doesn't reflect the specific characteristics of the company that we're valuing. The appraiser would then have to examine factors specific to the company and either increase or decrease the discount rate for company-specific factors. The appraiser might look at company versus some sort of industry metric and say the company we're valuing has higher debt load than the average company. We think this increases the risk premium of the company. We'll add an additional risk premium for the higher debt load. And any number of factors: competition, diversity of suppliers, diversity of consumers, geographic location, etc. Then
Right.
you arrive at the discount rate, which would be applicable to a cost of equity.
Mm-hmm.
And again, the appraiser then has to decide whether they're discounting cash flows to equity or invested capital. If they're using invested capital, we of course use the weighted average cost of capital, which would be a blended rate of return between the cost of equity and the cost of the debt that the company currently has to arrive at your weighted average cost of capital. Use either the weighted average cost of capital to discount the cash flows to the company, or the cost of equity capital to discount cash flows to equity,
Mm-hmm.
to arrive in present dollar terms.
So I can imagine that for a lot of folks who don't have a lot of background in finance or accounting and numbers, that a lot of these terms might sound like something very foreign to them, and they may not completely understand. But suffice to say, I mean, would this be a fair statement that essentially, if the more risky the cash flows are, the higher the discount rate you're going to use?
Correct.
Okay. So in an earlier stage company with a lot of variability in the cash flows, and the fact that you're projecting and you're having to do those projections based on a certain amount of guesswork, you would need to use a higher discount rate to compensate for that than, say, if you were discounting the projected cash flows of an established company with a lot of predictability in their cash flows. Is that right?
That's right. Let's just say that we're valuing two companies today. One is a manufacturing company that has a 30-year history. The other is a startup technology company. The manufacturing company with an extensive history may have a discount rate applicable to the cash flows to equity of 22-23%, let's say. The startup company, the tech company, might have a discount rate applicable to the cash flows to equity of 30, 35, perhaps 40%, again, depending on the specific risk characteristics. But because of the nature of the startup company, where all of the forecasted projections are subject to a much higher degree of variability, it would require a higher discount rate to adjust for the riskiness of those cash flows. Whereas with the manufacturing company that's been relatively stable, if the outlook is continued stability, you would have a much lower discount rate, presumably. Right.
So this would kind of correspond nicely to what you always hear, that these early stage investors, like venture capitalists, for example, or angel investors who are providing seed capital or very early institutional capital, they're seeking what appears to be quite a high rate of return, but in the end, that may be quite reasonable because there's a lot of riskiness to those investments.
Right, and what the listeners should understand is that if you're an investor, whether you're an angel investor, whether you're a seasoned private equity investor, and you have a spectrum of investment opportunities, let's say you have the startup tech company on the one end, which would probably be the riskiest. You have the opportunity to invest in the manufacturing company with a stable track record, or you have the opportunity to invest in a portfolio of diversified publicly traded stocks, blue chip stocks, or treasury bonds. You have the spectrum covered of the level of risk. Obviously, the treasury bonds have the lowest risk. They're implied to be risk-free. given that the U.S. government has never defaulted on its debt. Next would probably be the portfolio of diversified stocks, which, if you look at various sources and historical data, long-term expected return might be somewhere in the neighborhood of 8 to 12%. Then you have the privately held business, a manufacturing company, which is still riskier than publicly traded stocks, because the publicly traded stocks are much more liquid than the private company. It's going to have a higher required rate of return, let's say in the neighborhood of 25%. And then you have the startup company to compensate for the risk above the treasury bonds and the basket of publicly traded stocks. You might be requiring 40% return to compensate for the additional riskiness as opposed to those other assets.
Right.
So there's a spectrum on which the listener should be aware that it covers from anything from no risk to a very high risk scenario.
Right,
and
right.
The rate of return is going to reflect where you are on that spectrum.
Yeah, that makes a lot of sense, and I think it is useful to look at it in the terms you just mentioned of a spectrum of risk, running from supposedly not risky at all the way to extremely risky, where there could be an extremely high expected rate of return. But I think kind of a funny note here is that most folks who are starting a business, especially those that have some experience and have been successful as entrepreneurs, they would liken the risk of their venture to T-bills. Even though we all know better, there's so many variables at play when you start a company that there is quite a lot of implicit risk, and that has to be accounted for. So I know that a lot of times when you're actually performing valuations, it may be because the company is going to be sold, for example. I know there's a series of different reasons, but that would be one of the more common reasons. So if you were in the shoes of one of these folks right now who was just getting started with a business, would you suggest, and might you have some ideas on where they should focus, that they should be building it to sell it, building it to maximize the value from the get-go? And I realize that your answer may vary widely depending on what type of business they're going into, but I'd be interested to get your thoughts on that.
Well, the important thing for someone considering starting a business or that may have started a business just recently, there has to be consideration from the outset of an exit plan. What's the exit strategy? How are you going to convert your investment that you've made into cash? And that, of course, can be in various forms. It could be selling the company, converting it to an ESOP, having your kids take over. But there needs to be some consideration given to what's the ultimate goal in mind. How am I going to get out of this? No one lives forever, so they can't run the business forever. So they need to consider how are we going to get out of that. And sadly, many entrepreneurs are very excited about starting their business and are focused so much on the here and now that they don't give consideration to how they are going to exit that. As an investor, if you buy publicly traded stock today, you probably have in mind, well, I'm going to sell it when it reaches my investment plus 2 or 3 points. Now, the private business owner should be thinking in those terms as well. I'm starting this business today, I'm investing this much today, I'm going to get out at either a certain time or when the business increases the value to a certain point. And along those lines, the business owner should focus also during this time period in maximizing the value, because whether you sell the business, whether you keep it, whether you convert it to an ESOP, give it to the kids, you want to take the actions that serve to increase the value of the business long term. It shouldn't just be the here and now, what can we get out of it today. There needs to be a long-term perspective on both how to get out of it and how do we increase the value and increase our return over the long term.
Right. That is helpful. And you mentioned several, just kind of on the fly there, you mentioned a bunch of different exit approaches. And I know it's getting a little bit off the topic of valuation, but I know that you've had quite a bit of experience with looking at some of these other vehicles besides selling the company to find an exit. Another one that you mentioned was an ESOP. And that's one I'll ask you just to give a couple minutes on, just in terms of exactly what that would be in terms of selling out that way. And then any others, you think there might be a transfer within the family. I mean, just if you could just throw out a few thoughts and ideas on the ESOP concept and this whole idea of liquidity and cashing out, the exit planning, because I think I agree with you completely. That's one area that is very much overlooked for entrepreneurs.
An ESOP is an employee stock ownership plan, and basically, when you reach a certain size, if you have enough employees and they've been with you for a long time, some business owners would prefer to sell the business to a trust for the benefit of the employees, where then over time the employees own the company. It's a somewhat of a complicated procedure, and it's not appropriate for all businesses, but it is a viable and tax-efficient at times method of creating liquidity for your investment in a privately held business while also rewarding the employees who have helped you grow that business over time.
Does that approach involve using debt?
It does many times. What will happen is a trust will be set up. The company will borrow money to acquire the shares from the business owner. Those shares then go into the trust. The company becomes responsible for the debt service on the debt that was incurred to acquire those shares. And then the trust administers the shares based on length of service and whatever parameters the ESOP sets up for employees to be vested and receive shares for their time service to the company. But it usually does involve debt. It does not necessarily have to if the company has an adequate amount of cash or if they've built up an adequate amount of cash reserves. But 9 times out of 10, you're going to see it involve leverage of some sort.
Right. Okay. And I've heard, I've also, obviously heard and seen the approach, which would be an MBO, a management buyout. How would that how would that differ from this ESOP approach?
A management buyout, an MBO, is usually upper-level management using leverage to acquire the business from the existing owners. It doesn't necessarily entail all of the employees participating, although in a small business, if there's only 5, 6, 7 people and 3 of them are upper-level management, those 3 might get together and go borrow the money to acquire the business from the founder, the business owner, who may want to retire, achieve personal liquidity, whatever the motivation. And then those 3 or those 4, whoever is involved in the management buyout, then own the company as opposed to there being a trust where all employees benefit down the road.
Right.
Slightly different, but it still involves insiders in the company, in essence, taking over the business.
Right. Okay. Okay.
A couple of other options are, of course, selling it outright to another individual. You could sell it out to a private equity group if you achieve a certain amount of scale. Private equity groups, which are large funds that pool their resources to make investments in privately held companies, develop a platform and buy other similar companies to achieve economies of scale. If your business fits into their platform company, they might acquire it as a bolt-on acquisition. Many business owners think, well, I'll take my business public, but in most cases with small businesses, it's not feasible to go through the regulatory process to take a small business public. So
right.
Common misconception that many people who start a business think that they can exit it by going public and becoming the next big blue chip stock, but in most cases it doesn't really work that way.
That's kind of like trying to get into the NBA as a basketball player, right? It's a very limited set or group that can do that. On the topic of the being acquired by a private equity firm or having them make an investment in your company, that typically is referred to as a strategic buyer, correct?
Correct.
And sorry, that would be a financial buyer, excuse me. But the alternative would be a strategic buyer, right? So you've seen certain circumstances where, and I think you might have alluded to this, that there's a company, let's say like Cisco has grown this way, or a lot of the big companies that we know nowadays grew by acquiring a lot of companies in their space. Is that a common exit strategy that you see?
It is, and I think it's probably worth taking a couple of minutes to explain to the listeners the difference between a financial buyer and perhaps a strategic buyer. In the example that I use, where you have a private equity group that has a platform and is acquiring your business as a bolt-on acquisition, they're sort of a blend of both. But typically a financial buyer is one who brings nothing strategic to the table. They're just much like yourself and myself, Paul, individuals who have investment funds looking to acquire an investment that will give them a specified return on their invested capital. They're simply looking for a return on their money. They can invest it in the treasury bonds, the privately held company, the startup company, the basket of publicly traded companies. They're probably, in most cases, not going to be involved in the daily operations. They're simply going to have a management team in place generating a return for them on their investment. The strategic buyer is one who, for whatever reason, if they're in a similar line of business, can acquire your business and bring economies of scale to the combined company through a reduction of costs, increase in revenues, some other sort of synergies that may be able to be had in combining the two similar companies.
Okay, that's helpful to understand the difference between those. To switch gears a little bit here, Robbie, in another conversation you and I had, you mentioned to me a trend that you're seeing out there that I think might be useful and instructive to those listening, which relates to how people are funding their companies. You've seen quite a few valuations that you've done recently where the entrepreneur was starting the business with capital that they had withdrawn from their 401k plan. I would imagine a lot of people don't know that that's even possible, but I want to ask you to just talk a little bit about how that works, and maybe we'll even talk a little bit generally about, where that may be advisable, where it may not. So what are your thoughts on that approach?
Well, one of the biggest challenges, obviously, for someone starting a business is the capital. Most of them don't have tremendously deep pockets from which they can draw funds to start the business and carry it through until it achieves profitability. And many of them opt for either small business association loans, the Small Business Administration-backed loans, or some funding from banks, friends, family, lending groups. The trend lately has been folks who may have been laid off from a job, lost their job that they may have been at for a substantial amount of time, to have accrued funds in a 401k. They are rolling over the funds from the 401k into shares of privately owned stock in the companies they're starting up. And in most cases, they're starting franchises or small businesses, sub shops, auto repairs, service-oriented businesses, things of that nature. It's a growing trend. It has to be done correctly and very carefully, which requires both highly competent legal counsel and advisors on this transaction, as they are unique transactions. But the IRS has seemed to have blessed in some way these transactions. And there are many companies out there that are doing this. But like I said, it requires competent legal counsel, good financial advisors, your CPA, and the folks that are versed in the legalities of doing this rollover. But it is a growing trend. Many people are doing it if they've been displaced from job losses because of the weakness in the economy, laid off, and they're basically on and starting a company to buy themselves a job, as opposed to jobs that are not out there currently in the marketplace because of the economy.
Right. Well, one of the things that strikes me is that if we kind of put together a couple things from our conversation here, we were talking earlier about the spectrum of risk and the fact that when you're starting a small company, you're going to be toward one of the extremes of that spectrum, which is not the lower risk extreme. You'd be toward the higher risk extreme. Obviously, it would depend on what type of company you're starting, but it's interesting to think that, often when people are investing the money they have in their 401k funds, they're not necessarily going out there looking for the most risky investment around. They're trying to, at one time, preserve their capital and make a decent return. But in this case, where they're taking the 401k funds and they're funding what is presumably quite a risky venture, I think it's something that has to be considered very carefully And while there may not be, maybe it's the case that they're in a situation where there's not a lot of alternatives, as you mentioned. Maybe they were laid off, maybe they couldn't find a job very easily, and they thought, well, I'll start a business, and I've got all these 401k funds. Why don't I just go ahead and do that? But there is somewhat of a mismatch there between what you'd look for the riskiness of the type of investment you'd use that capital for. What are your thoughts on that?
It is certainly somewhat disconcerting to see so many of these people dipping into their 401ks to start businesses that may be new to them. For example, if someone who was working in the auto industry got laid off, now dipping in their 401k to start a restaurant, they probably don't have any experience in running a restaurant. It's going to be a new venture to them, which increases the risk profile even more. And the troubling thing that we're seeing is that these folks are starting these businesses without any type of adequate business plan. In many cases, they don't even have projections. They haven't done any type of break-even or cash flow analysis for the business. So it's somewhat alarming in that perspective that they're not getting good enough advice to put together a viable business plan. And if they were to do so and to do some cash flow analysis, break-even analysis, it might change their mind, perhaps about taking the funds out and investing in this particular type of business. But it is a growing trend, and I think it's a function of what's going on in the economy. Folks are frustrated. There's no jobs out there, and they're buying themselves a job thinking, well, I'll take a chance on this and making it on my own, as opposed to just sitting around waiting for something else to come along. I'd venture to say that most folks here in America dream of owning their own business.
Right.
Many of them don't get to, and for those people that are taking these 401k plans, they in their mind see it as an opportunity to own part of the American dream of small business ownership.
Right.
It's
right.
something that needs to be undertaken very carefully and judiciously, and only after careful consideration of the risk versus the potential upside. And if you put it in those terms with the spectrum of risk, as you said earlier, most of these folks think that their business is, like risk-free rate, totally risk-free. But in many cases, it's not that simple.
It's at the other end of the spectrum, actually.
It's at the
Yeah.
far end of the spectrum.
Well, I think you make a great point, and I think that as you know, I'm a huge fan of entrepreneurship and small business, and I highly support people going out and starting their own companies, and I think it's the best possible thing you can do, but it has to be done prudently, and I think that a couple of key things to pick up on what you said there. If you're going to take money out of your 401k and you're going to start a business with it, a couple things that you need to do. One is you need to plan adequately, and I know you're trying to get it done kind of fast, probably, and that makes sense, but at least do the basic analysis to understand whether this business ever has a chance. It's kind of set, a little bit makes you sick to the stomach to think that you'd be taking money out of your retirement plan to go ahead and start a company without having done a basic break-even analysis, basic cash flow analysis, all these basic analyses that would let you understand whether this business has a chance to be successful in the best set of circumstances. Because as we all know, as entrepreneurs who've started a bunch of companies, nothing ever goes exactly according to plan. There's always a variation on almost every assumption that you make, and you need to be prepared for that, and you need to have a cushion in your plan to make sure that you can suffer through some of the challenges. And back to you mentioned the break-even analysis, cash flow analysis. How about a basic budget? Anything. How exactly are you going to use the funds? This has to be planned. It cannot just be kind of done out of thin air and for shooting from the hip. And then the other point you made in that I think is really important is that if you're in the auto business your whole career, let's say you're a finance manager at an auto dealership, and you built up a nice 401k and you got laid off and you're going to start a restaurant. Well, running a restaurant is materially different than running the finance department in an auto dealership. And that would implies that the risk is a whole lot more for you to go ahead and do that, and you're using your retirement funds to do that. So think carefully about which business you're going into and using your retirement funds for. Another question I want to ask you, Robbie, is because I know you do a lot of valuations in the area of SBA funding. Any points you could make on that, the Small Business Administration funding, and the types of companies you're seeing there, or any trends that might be of interest to those listening?
The SBA lending market has been very busy the past year and a half. When the economy took a downturn, additional funds were budgeted to the SBA to back lending to small businesses, multi-billion dollars over the past several years have been put into this plan, more so than normal, to try to stimulate the economy. There has been a huge increase in the number of valuations required for SBA lending purposes. The SBA actually, prior to releasing the funds, the guarantee, requires a business valuation performed by an independent party to establish the value of the business. What we have seen mostly the past 2 years have been existing businesses that, because of the economy, are going to the SBA, borrowing funds to basically continue operations, not expand operations, but just maintain operations to try to weather the storm. The other group of borrowers that we've seen with SBA-backed loans have been the startups, folks that are starting a business, need some sort of financing. They're going to their bank saying, well, if we can get it approved and backed by the SBA, we can loan the funds to you. Because the banks, because of what has happened the past several years, have become much more cautious in their lending, and they want to make sure that the loan can be serviced by this business. And so you're seeing the majority coming from businesses that are just funding operations, not expanding, just trying to keep the lights on, and a smaller portion funding for new businesses. I think it's important also to note in this discussion and in the previous discussion we had, this is a tough time for the economy, and I think we'd all agree on that. We've seen better days economically. And to go out and start a business now from scratch without any type of planning, it just sort of stacks the deck against you. I have tremendous respect, and I wholeheartedly advocate, as you do, entrepreneurship and the people that go out there, take the risk, start a business, grow it, and make it into something. That's American ingenuity and hard work at its finest. The challenge we see now, though, is that because of what's going on in the economy, to go out and start a business in this climate, you've got to be pretty darn sure that you can make it. And it's tough. It's tough. If you're that auto worker that got laid off and you're starting a restaurant in your town, you're competing with much larger organizations, franchise companies, corporate-owned restaurants that are having a hard enough time weathering the storm, let alone you trying to make it. If they make it, more power to them and great. But they've got to be cognizant of the risks of what's going on in the economy now and how feasible is it to start your business today when you've got established businesses that have long histories that in some cases aren't making it or are having to borrow money just to fund operations in hopes that they can weather the storm and turn the corner when the economy turns the corner at some point indeterminate in the future. Right.
No, that's I think that's wise advice, and I think the SBA loans in particular, it's not as though those are without their personal guarantees, correct? It's this is not non-recourse lending. So if something goes wrong with the business, you can be on the hook with your own personal assets. That's the idea behind it. That's why the banks are willing to lend. In addition to the fact that they're getting a guarantee from the SBA, they're going to have your assets. You're going to have your assets exposed as well. So I think your point's well taken, Robbie, that this is a challenging time to start a business, and I think that for that reason, folks have to plan very well. They need to really have a good handle on what they're doing and make sure they're getting into something that has a high probability for being worthwhile in a good scenario, so that if a good scenario doesn't necessarily happen, they can at least make it run for now, as you said, and really expand it when the economy gets better. The other point related to that, I think, is that entrepreneurs don't necessarily have to start a full-time business right away. I mean, I know the topic of our conversation is on largely on valuation, but now that we're on this point of people starting businesses in risky times, you don't have to start a full-time business right away. You can start a part-time business and keep another source of cash flow while you do it, assuming that you haven't lost your full-time source of cash flow. So that would be another way to hedge that risk of starting a business when the economy has its challenges. Robbie, I think we're getting toward the end of our time, but I wanted to ask you if you had any other points that you'd want to make to the group of entrepreneurs that are listening.
Well, I certainly don't want my comments to be construed as hopeless negativity. There are many opportunities out there, and folks looking to start a business, the point I'm trying to get across to them is plan well. These are tough times. These are challenging times for established businesses as well as startup businesses. So if you're an entrepreneur out there looking to go into business for yourself, I think you have a very good point. You don't have to go in guns blazing right from the start. Maybe a tempered approach to it. However, in some cases, the businesses you're looking at, if you're starting a restaurant, you can't just do it part-time. And not that I'm advocating starting a restaurant, that's just a convenient example.
Mm-hmm.
But there are tremendous challenges out there now, but there are also tremendous opportunities as well for the people who can weather the storm. It's challenging. It takes really good planning, and I don't want these folks listening to think they have to sit down and come up with a 200-page detailed business plan, but they need to have in mind and some sort of written plan regarding budgets, forecasts, how we're going to market the business, how we're going to increase the business, how we're going to advertise, everything you'd find in a business plan. That's going to be crucial. Plan for the worst and hope for the best is an old saying. And they've got to consider that things aren't going to go as planned when they start the business. There are going to be challenges that they're not even going to dream of that come up along the way. Also have a clear strategy in mind for when and how you're going to get out of the business down the road. For example, if you're this auto worker that we use that got laid off, he might be middle age, in his 40s. His time horizon, if he wants to retire at 62, 63, 20 years. Start thinking, well, are we going to grow it? We're going to exit at that point sooner? What are the plans? Obviously, the younger entrepreneurs have a much longer time horizon, and many things can change between now and then. But business plans give you guidance, and they can be changed along the way depending on the existing circumstances. Make the decisions when you're running the business that are going to increase the value of the business. It may seem at the time that it's a good idea to have the business buy myself the luxury car, etc. And there may be some benefits to doing that. But long term, think of how your decisions create value. Because down the road, if you start the business today and 10 years from now you want to sell it, and you have financials that don't bear out in your mind what you want to receive for selling the business, there's going to be a disconnect. Buyers are going to look at the numbers and say, well, the numbers don't support what you've said. The valuation professional can make certain adjustments and assumptions regarding that in the valuation process, but it's much easier if you have a clean set of financials along the way. And if you've had a business plan and you've shown the progress of the business along that business plan, it gives so much more credence and credibility to the work you've done in building the business when you go to exit the business, or when you go to look for debt funding or take on other investors, etc. So I would encourage the entrepreneur to look at these things, consider all of these things, realize that there is risk in it, but also in taking that risk, usually you're compensated with a higher rate of return. It's hard work. Entrepreneurship, however, is one of the most satisfying things that you'll find. Both you and I are entrepreneurs. We started out and we've built things over the years. And it's a gratifying feeling to be able to start with nothing and build it into something. And
Right.
It takes a lot of hard work. It takes a lot of time. It takes a lot of commitment. But it's a satisfying feeling. And
Right.
these
Yeah.
entrepreneurs out there, you know, we should take our hats off to them because they go out every day. You know, the baker down the street, you know, the service business, the CPA, whomever. And they're the engines of growth in this country. They take the risk, they create the jobs, and they reap the rewards down the road.
Right, right. No, I couldn't agree with you more. I mean, I know you and I are both have been entrepreneurs for a long time, and you know we have a lot of respect for entrepreneurs. And I think the final point you made, that you know the unifying message here is that we certainly don't want to be negative on entrepreneurship because we're anything but. We're at the other end of the spectrum, but we want to throw out the caveat and make sure everybody's on the same page that although no plan is ever going to be perfect, you need to do some basic planning and analysis to understand whether the business that you're getting into makes sense at all. And then once you can come to a basic understanding that, yeah, this could be a really good business, then you figure out how to make it happen and how to optimize it from there. And you manage to navigate all the challenges that come along. So, Robbie, I want to thank you very much for your time today. Your comments have been very insightful and I think can be very helpful to all the entrepreneurs out there. And I know we left a lot of ground uncovered. So hopefully we'll be chatting again on some of these some other entrepreneurship related topics. And I also want to just have you let people know how they can get a hold of you for your focus. You have all the credentials and so much experience with having done hundreds, if not thousands, of valuations, but you're also very good with planning, doing business planning, and anything along those lines. You've got a lot of experience and skill with. Tell the folks how they can get a hold of you best.
Sure. They can visit our website, Highland Global, www.HIGHLANDGLOBAL.com. And they can visit there. They can contact me directly from there. There's also numerous articles that we've written over the years, a couple of the books that we've written that talk about 7 Deadly Sins of Business for privately owned businesses, different case studies. They can take a look at those. They might find those insightful as well in creating value in their own organization.
Yeah, I guess now you bring that up, it's probably worth me throwing out the disclaimer that you and I actually started Highland Global together several years back. But since I'm in a couple of different businesses, and you're focused on that and been building that business, so we've run some of this entrepreneurship road together, and remained great friends in the process, and still have a great deal of mutual respect. So thanks again, Robbie, and I'll look forward to talking with you again soon.
Appreciate it, Paul. Look forward to doing it again myself.
Okay, take care.
Thank you for joining us for another edition of the Entrepreneur Maestro series, your source of insights and inspiration from successful entrepreneurs and advisors. If you're not already a subscriber, go to entrepreneurmaestros.com and subscribe. Also, visit the Company Founder blog at companyfounder.com for more great entrepreneurial insights, tools, and connections.